Marina, why are SMAs, or separately managed accounts, such a hot vehicle in the wealth management industry right now?
Separately managed accounts are the ultimate in flexibility. Each and every portfolio can be molded to the client's objectives and goals. And the reason that molding can happen is because the client owns the underlying securities outright and the associated cost basis. So what that gives rise to is the ability to proactively tax loss harvest at the security level, the ability to restrict individual stocks or multiple stocks, groups of stocks, to hedge an individual stock to reduce the risk profile of it. And then, even more interesting, to bundle that separate account, convert it into an ETF, and increase its portability.
And there's a lot of different strategies. I know there's a lot of personalization involved in the SMAs, but there are strategies out there as well. Can you talk about that?
Sure. So the strategy that has garnered some of the most interest and excitement and commercial success over the last 5 years is direct indexing. I think probably most of your viewers know what that is, but just quick recap. It's a strategy that seeks to match the index returns on a pre-tax basis and outperform after tax. And all the enthusiasm around direct indexing has given rise to a whole new set of strategies or solutions that are seeking to address the concentration in low cost basis stock. That's become a very prevalent thing given the market performance and how concentrated it's been. And so investors are looking to deal with concentrated low cost basis stock and figure out how to manage it in a low risk, tax efficient manner.
And as the market has risen, have you seen more demand for SMAs? Because one would think that perhaps people graduate from owning ETFs into an SMA strategy when they can own the individual stocks.
We have. I mean, the SMA industry has grown rapidly, but it's still sub $4 trillion as compared to the $30 trillion investment products landscape in the US. So still a fairly nascent part of the industry, but it has garnered a lot more appeal because of the tax management flexibility. So more and more investors are gravitating towards separate accounts so that they can manage their own portfolios to their specific level of tax tolerance, tax liability tolerance, and also customized to their needs.
Can you talk a bit more about the customization trend and what it offers investors, as opposed to just being able to deal with their own taxes and not be involved in other people's mutual funds?
Sure. So the customization, the options for customization has grown rapidly. It started with something as simple as restricting individual stocks, restricting groups of stocks to express preferences or a values orientation. But now it's broadened out to being able to hedge the specific security, as I mentioned before, being able to sort of put a collar strategy around a security, and that allows you to transform the risk of that security and then either hold it for a longer period of time or unwind it in a much more tax-efficient manner.
And this is the part where you get to talk your book. How does Natixis do SMAs better than your competitors?
So first of all, Natixis has been in the SMA space for 25 years, before folks even really knew what SMA stood for. We currently have nearly $90 billion in SMA assets, and we have the full range. We have equity, we have fixed income, we have alternatives and option strategies. So we really offer the full range, the full gamut of separately managed account strategies, and we've been proactively tax managing separate account strategies for the better part of the last 2 decades.
And then finally, so where can the SMA industry, if you will, go from here? What advances do you see happening, perhaps even in 2026?
Well, one of the most exciting strategies people are talking about everywhere you turn is long-short tax advantage strategies. So this is a relatively new phenomenon where you take the long-only tax managed strategy, and then you put on an extension, a long short extension. And what that allows is for you to have what we call kind of more surface area, to be able to tax loss harvest more often to a greater extent across more market conditions. So it's essentially turbocharging the tax loss harvesting potential of your portfolio.
All right. Well, thanks for coming on and talking about it.
Thank you.